Hello everyone. Today we'll be talking about supply and demand zones. This is a strategy that has become very popular because of its effectiveness. Now, this is my first ever video to post on YouTube for more than 5 years of trading. And this strategy of supply and demand concept is the one that I have been trading. Now, I will take you through a full mechanical strategy that I use to trade these supply and demand zones. But before we continue, we need to understand the Wyckoff theory about this supply and demand zone. The Wyckoff theory about the supply and demand zone states that if the demand is greater than the supply, then the price will rise. And if the supply is greater than the demand, the price will fall. And if the supply and demand are both in balance, the price will consolidate, like in this example here. Now, we need to know how to locate these supply and demand zones on our chart. We'll start with the demand zone. A demand zone is where the price makes a sharp move. That is big green candles. So what we do is that we locate the first impulse move, which is big green candles. Locate the base of the zone. That is where you press a rectangle tool at the high of these red candles here and the recent swing low. So you press your rectangle above the red candle preceding the move, the first impulse move, and another one at the recent swing low. So this is a demand zone. Why? Because we have a first impulse move. We have these big green candles with no wicks or minimal wicks. So we have a demand zone. So the plan is to trade when the price come back to this zone. If the price come back to this zone, then we expect the price to reject the price around this zone or below this zone. So when the price comes to this zone, you enter a long position, stop loss below the zone. That is a demand zone. Now we need to locate the supply zones, and to locate the supply zone, you need first of all to locate a first impulse move, which are red candles. This is a first impulse move. We have red candles with minimal or no wicks. So here we have a supply zone. Okay, you press a rectangle tool at the low of the green candle and the recent swing high around the move. Like in this example, we have these red candles with no wicks or with minimal wicks. So what you need to do is that you press your rectangle here at the lowest price of the green candle and the recent swing high around the move. So the plan is to go short when the price approaches this area. In this example, the price came back to this area, and what you see is that the price very fast rejected the area and continued to go down, seeking the next demand zone. So here we have a supply zone. We have a supply zone here. Now, we know how to locate demand zones and supply zones. But we have 4 types of demand and supply zones, but they are classified or categorized into 2. The continuation supply and demand zone and the reversal supply and demand zone. We'll start with the continuation. In the continuation, we have a rally base rally, and they form during an uptrend when the price is going up. That's when we have a rally, then a base, and then another rally. For example, here, the price was rallying, then we had a base, the price continued to rally, then we have a base. So when the price returns back to these zones, we expect to see a reaction or the price rejecting the zone and continue to go even higher. As you can see, the price came back, rejected this zone, and continued to go up. So here what we have is a rally, a base, a rally demand zone. So remember, the rally base, rally demand zone, they are formed during an uptrend. Now, what about during a downtrend? During a downtrend, we have drop base drop, and they form a supply. They form a supply zone during a downtrend. In this example here, we had the main supply zone here. This is a main supply zone. The price dropped, then we had a base here. This is a base, then the price continued to drop. So when the price come back to this zone, we expect the price to reject this zone and the price is above the zone. So here we have a drop, base, drop, supply zone. The plan is to wait for the price to return back to this zone and enter a short position. As you can see, when the price approached the zone, we see the price is rejecting this area and the price above the area. So the plan is to go short here, stop loss above the zone, and you target the next demand zone. So that is it with continuation structure. Now we have reversal structures. The reversal structures, we have a drop base rally and a rally base drop. A drop base rally, they form a demand zone where the market changes from bearish to bullish. In this example, the price was in a down move. Then the price broke above this resistance area. The price left a demand zone here. So when the price came back here, we expected the price to continue going up or to reverse from going down to going up. Okay. So here, this is also a drop base rally demand zone. We had a drop, the price tapped to this demand zone, then the price reversed and started to go up. So here we have a drop based demand zone. Okay. Another structure we have on non-reversal structures is a rally base drop. And a rally base drop, they form a supply zone during an uptrend. Like in this example here, the price was in a temporary uptrend. Then the price started to go down, leaving this supply area here. So when the price returned back to this zone, you see the price continued to go down. So here what we have is a rally base drop supply. All right. Now that we know how to locate our demand and supply zones, the next thing is to align ourselves with the smart money. And who are these smart money, or what is smart money? The smart money are big financial institutions such as banks, and they are responsible of controlling the market. Most of time, they move the market against the retail trader to maximize their profits. Another thing to note is that the smart money, they act at their own interest to ensure that they buy low and sell the highest prices. Now, how do they do this? One way the smart money uses to buy at the lowest prices and buy and sell at the highest prices is using a liquidity clear out. A liquidity clear out is where the price moves all below an area where stop losses of retail traders are placed. In this example, we have stop losses of the retail traders who went long here. The smart money then pushes the price and execute those stop losses of the traders who are buying here. And immediately after they execute those stop losses, they reverse the market. So these are the special patterns to watch out. Areas with equal highs and areas with equal lows. In this example, the price went up, liquidated these orders that were here, and immediately the price went back. Here is another example. We have equal lows, a double bottom. Here is where the stop losses of little traders who went wrong here are placed around this zone. The smart money then pushes the price towards their stop losses orders and immediately reverses the price. Another pattern to watch is the triangles and wedges. Here the price was moving down and is disconnected by a wedge. The price broke below this trend line and immediately the price reversed and went up. So in order to align yourself with the smart money, you need to watch those areas. The areas with equal highs, all equal lows. These are the areas that you really need to watch. If you found this video helpful, kindly like and subscribe. The next video will be how to align yourself with the smart money using supply and demand strategy.